If you're an investor, if you're a VC, if you're a private equity firm, if you are looking into investing or buying an e-commerce business, you need to pay attention to these specific elements and objectives. Hello everybody, welcome to Search. This week we will talk about e-commerce due diligence for venture capital, for private equity, and for angel investors. Now, Joe, we get this request, I would say a few times a month. We have a prospect that comes in, says, I'm thinking about buying this e-commerce business, but I need help basically breaking down what they've done so far, what their technologies are, what kind of marketing initiatives have they done, are the metrics accurate, and they want to pay the right amount, and they actually want to negotiate, because it's not only about what's in the income statement or the balance sheet, right? There's also a lot of intangible assets like visibility and different technologies that an e-commerce business might have. Mm-hmm. And when we get these requests, we have a specific checklist that we put them through, which is a mergers and acquisitions checklist for e-commerce. But there are details with operations as well. They might be doing drop shipping from third-party logistics. They might have relationships that might be lost. They might have a specific relationship with their customers that will be lost when it changes ownership. Mm-hmm. So there are all these different things that we obviously ask and we follow through. What do you think are the top 3 things that you need to look at when you are trying to acquire an e-commerce business or invest into an e-commerce business?
The 3 things that we look at are customer lifetime value, engaged users, and what their organic visibility looks like. Now, the process in which we uncover all of these is a pretty extensive process. So step number 1, we need to perform a full deep dive marketing analysis of that business. We need to identify where they're generating their users from, whether it be organic, paid, so on. And then at the same time, we need to then see from a revenue standpoint. So we perform a full in-depth marketing analysis. Now, the KPIs that we're going to be looking for are customer acquisition costs, customer lifetime value, average order value, return visitors, new visitors coming to the site, and of course, what channels are driving these individuals to the site. So after we've done that, then we go into the technology. What technology are they using? How can they utilize additional technology or cut costs on technology that they shouldn't be using? And then last but not least, we take a look at their back-end operation from a merchandise standpoint, right? Where are they sourcing these products from? Could they potentially be saving money there and increasing their margins? Then after that, we look at fulfillment, right? So at the end of the day, it's from the forward-facing operation to what's generating revenue to the technology that you're using, all the way to your back-end infrastructure, so that these private equity firms and these VCs don't fully have the personnel in-house to be able to dissect each and every one of these in order to make that decision on whether, in fact, they're going to see a return on investment from purchasing that e-commerce store, whether it be in 90 days, 100 days, or 100 years. So that's really why we step in those situations.
Got it. As an investor, you're looking at the growth rate, right? For any business, you're going to go to past 5 years and you're going to look at the growth rate of the actual business. And when you look at the growth rate of an e-commerce business, what we look at is we look at today's data, which is what they have done so far, and we look at the potential growth or potential opportunity in what we can change, what we can save, right? It's more about making more money than saving money, though, because with e-commerce, you can get explosive growth if you're doing the right execution, if you're following the right strategy. So the due diligence that we do is not only about the current state of the business and the current operations or current marketing or current growth opportunities. It's about the future value of the business as well. And this is where I think we differentiate from other firms that do due diligence, is because we own our own e-commerce operations and we know the steps that you need to go through and the exact formula of CPA, cost per acquisition, average order volume, and lifetime value to be able to determine, okay, we're going to buy this for $10 million. We're going to put in $3 million for a period of 12 months to scale to $25 million. And the objective is very important as well. A couple of different objectives. Obviously, private equity and VCs, they want to build it and they want to sell it, right? So we look at that formula of what a potential buyer is going to look at. Who might be a potential buyer for this specific business? And what angels are looking at is they're looking at, 3x, 4x, 5xing their money with a specific investment. For angels, we look at the owner, the operator. Are they 100% in this business? Are they doing the right things? Do they need coaching? It depends on what level of acquisition we're doing. Is it a $500,000 acquisition or is it a $20 million acquisition? And the scaling phases are all different. This is why this process is incredibly important. If you're an investor, if you're a VC, if you're a private equity firm, if you are looking into investing or buying an e-commerce business, you need to pay attention to these specific elements and objectives. And how this process starts is with a very basic conversation. Even if you don't know which e-commerce business you're going to buy, we're in this business. We have clients who want to sell. We have clients who want to buy. We're not really in the business of brokering these deals, but we're in the business of identifying these opportunities, going out there and saying, look, this brand is really, really ripe right now, or this brand is really, really established. And we have the means and the know-how to identify these opportunities. And Joe, let's talk also, there's a legal component here as well. And there are a couple of attorneys that we work with that do this. Talk to us about why it's important to combine. Obviously, we're not lawyers. We cannot give any legal advice, but talk to us about merging this due diligence process with the legal aspect of what needs to happen and how that actually saves you money or saves you opportunity as an investor.
So, Duran, we also work with a lot of business attorneys that step in during this due diligence process alongside with us. And we've seen that this has been extremely beneficial for these VCs and equity funds and angels. So, why is this so valuable for them from a pricing / time and conditions standpoint?
So what a due diligence process is it's a negotiation process, right? You say, okay, my business is worth this much. I'm asking for this much. We sign an NDA and a non-compete or whatever agreements we need to sign, which, by the way, the legal needs to be involved in. And then we go to work. We look at every single aspect of this business. There's a CFO involved as well, an outside CFO firm that also checks the books, right? We didn't even talk about that, but that's a part of it. So legal, I would say financial, technology, operations, 4 legs, right? Regardless of you being a CFO or an attorney or on the operations or technology side, this is a unified mergers and acquisitions process. So the due diligence determines if the business is worth that money, and it determines what the missing elements are for that growth strategy that we're looking at. So the reason that it's very important that it goes in this triangle is due to the fact that we will find things in the due diligence that affects the cost of the business. Obviously, based on who hires us, we're going to pull it to that way. If the VC or the acquisition side hires us, we're going to pull it to this way. If the e-commerce business owner hires us, we're going to pull it to that way. And these conversations start 6 to 12 months before you actually decide to sell your business or before you decide to buy an e-commerce business. You don't just wake up one day and say, I'm going to buy something or I'm going to invest in something. So with our clients, we are always grooming them to have the highest net worth amount possible. So they have their technologies in place. If they have a B2B operation, you have to have Salesforce. Like there's no way around it. You have to have a very firm Salesforce, very firm sales playbook if you're an e-commerce B2B business, right? If you are 100% B2C, you have to have a nurture process. So this is why the legal side of it is very important. We're actually very involved with the attorney in creating that purchase contract due to the fact that we want to negotiate in that contract. And we want to sometimes put clauses there because there might be an earn-out. It might not be a direct purchase. You might be buying only 51% of the business, and you might be leaving the owner-operator there to acquire an earn-out at the end of 5 years or to deserve an earn-out, right? Different structures. So legal needs to be involved because of these different structures.
Yeah.
I think we covered enough here, Joe. That's it for the mergers and acquisitions side of this for this week. We'll talk to you guys next week.